What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Charlie with you, the full gang back together for the What's Making Headlines wrap-up of the week. Ben, how's your week been?
It's been good, just coming to terms with working in a typing-heavy job with a broken finger.
You've been
a difficult
injured
thing.
again from Aussie rules.
Yeah,
this is a brutal game.
Yeah, I think it's time to add some calcium to my diet as well, maybe, or choose another hobby. But it's been good to be back, and thanks for filling in last week.
All good. And we are very glad to have you back, but very sorry for your injury, obviously. And yes, good luck learning how to type with one finger.
That's it. Yeah.
But Charlie, how's your week? It's been busy.
Yeah, it was a lot of financial reporting and some updates from the government as well. So it was all systems go.
All systems go. I feel
week.
like the perils of being a journalist is that nothing ever stops. And so you could just continue writing. Thank goodness we have business hours because we don't have to. But like everything has been happening this week.
Yep.
And I feel like we say that every week. But yeah, some of the big stories and probably the biggest one that lots of people would have been reading this week has been from Austrac, which came out with some pretty interesting data, having done this whole mortgage fraud probe, which has been going through pretty much this whole year. And they released some new information from us from the Fintel Alliance. Charlie, what were they saying?
So we got a major update from Austrac on Wednesday on their Operation Claw, which commenced in February. And this was after CBA self-reported to authorities and the regulators about suspected mortgage fraud on its book, in its mortgage book. And so the agency, Financial Crimes Agency, Austrac, yesterday, with a media statement released
On
Wednesday, said that it had referred mortgage brokers, accountants, lawyers, and other entities and companies it suspected of being involved in this mortgage fraud scheme to the relevant authorities and regulators and the ATO, and that's ASIC and whatnot, federal and state authorities. So this was huge. This was a huge update from Austrac, and so we reached out to Austrac, asking what the numbers.
Who is it?
Yeah, who is it? What are the numbers? What are the exact figures that we're dealing with here? And they confirmed they'd refer 200. So this includes obviously brokers, lawyers, accountants, and companies to the police, tax agencies, and the corporate regulator, and also obviously that includes names of people and entities it believes are potentially linked to these mortgage fraud schemes that are gripping the banks.
Yeah, unfortunately, we didn't get the names. Obviously, they're not going to tell us that just yet.
No,
so we
yet.
Can't name and shame anyone. And I know that lots of people have been asking us, being like, who is it? What are they doing? And specifically for the brokers, I think people are really curious to see who's been doing it. But we did see some sort of detail around which lenders they were looking at and what kind of things they were worried about.
Yeah, so they identified suspected fraud involving overstated incomes, misrepresented employment, and business activity that was either fabricated or could not be verified. This is according to the Fintel Alliance. And Austrac told the advisor that, quote, recurring involvement of some brokers, accountants, and other intermediaries was also identified, which is pretty big. And it's also believed to be kind of uncover instances of offshore or third party money being used to settle purchases. And it did state that it believes this is potentially in the hundreds of millions of dollars in suspect lending, and this is largely linked to Sydney properties specifically. So they have given us a fair amount of detail. They said they'd received 1,800 suspicious matter reports after it had sent out like an initial threat alert to over 100 lenders and industry associations when it commenced this investigation.
Yeah, I think we ran a story when it did that.
Yep, and it's now confirmed that it's writing to entities across the mortgage market, and this obviously includes lenders, urging them to improve their controls and help prevent these fraudulent activities. And there's obviously comments from Brendan Thomas, the Austrac CEO, but he said, Quote, the scale of this activity should be a wake-up call for every lender. The same warning signs were found across banks that together cover the vast majority of the Australian mortgage market. And he said this is not identified or not isolated to one specific bank.
Yeah, because they looked at 10, didn't they, in the Operation Claw exercise?
Yes, yeah. So it was a broad fact-finding mission and investigation.
Yeah.
And they've basically gone, it's not isolated to one lender, and there's multiple kind of instances of fraud. And there was an article that ran on Friday this morning on the Advisor.
Associations.
No, it was from Experion. Basically, how sophisticated fraud has become, AI generated fraud has become, and Austrac obviously believe that that's involved. AI generated pay slips and income verification and company registration data. All that kind of stuff. I think
the really interesting thing from this as well is that they're actually saying they didn't find in Operation Claw any widespread money laundering. So the criminal aspect of this, in terms of what they were most worried about, I think the anti-money laundering, counter-terrorism financing kind of angle of it has been what a lot of people have been focused on when we've been talking about mortgage fraud. And of course, there isn't just one area of mortgage fraud here. We're talking about multiple different things. But for Operation Claw specifically, I think Brendan Thomas, the Austrac CEO, was saying we didn't find any widespread systemic issues with money laundering, but there are weaknesses, and that is what we're worried about. And it seems to be, kind of reading between the lines, it seems to be the thing that they're most worried about is people are using artificial intelligence to create this documentation to suggest that they're earning income in Australia and purchasing property in Australia when they are not actually in Australia.
No.
So basically, I think the concern is that it's sort of people circumventing the foreign investor kind of rules, and overseas buyers, particularly those in China, parking money into real estate in Sydney and doing it through doctored means. So that's the concern, has been like, why are they doing this? What is the purpose? And of course, this kind of problem, that the fact that lenders aren't identifying it, is what they're most worried about, being like, we need to tighten this up because it could be used for money laundering and it could be used for criminal investigations. But I'm sure as investigations continue, there may be instances of criminal activity that they are finding. But at the moment, it seems Austrac hasn't really found that yet in terms of widespread systemic issues, but it is flagging it as a risk.
Yeah, I think it was good that we got this update from them as well, because there's a lot of media reporting going on and kind of general unease about the fraud kind of situation. So we kind of know that, as you just identified, it doesn't think that it's a widespread money laundering scheme, which I think is particularly interesting, seeing as though there was media reporting to suggest that was the case initially.
Yeah, and it sounds like something a lot of the lenders are having trouble with as well. So it sounds like
everybody is aware of it. They're all like, we know, we see it. We're trying to fight against it quickly. But of course, as soon as you fix one thing, another thing happens. So I think constant learnings from this. But interesting as well, they were saying it's sort of hundreds of millions, because we have heard anecdotally from the lenders saying it could be up to 4 billion. So this specific Operation Claw looked at hundreds of millions, and as I said, sort of 10 lenders, but the wider issue could be more broad. And of course, that's what we're sort of more worried about, is seeing, some of the major banks, as we mentioned already at the early beginning of this year, having self-reported. So that was some juicy juice for us this week, although, couldn't actually get the names, which is a shame. But I guess, for defamation reasons, we will name them when we have that confirmed.
This is an ongoing saga as well. They've referred all of these names, both individuals and companies, onto authorities, including the police.
Yes.
So you've got to assume that
there's some criminal activity here somewhere.
Yeah, exactly. This is going to continue to play out. We're probably going to get updates from the police as well, and authorities, if they lay charges,
Because they have been making arrests over the year so far already, and different police investigations, as we said, regulatory investigations. We've had, accountants charged, solicitors, brokers, we've had bankers arrested. There's been all sorts kind of across the ecosystem having been arrested already for mortgage fraud in different areas, mostly in Sydney, I think, actually. But really looking at how far does this go, and working together as a finance industry to try and stamp it out. Because, of course, that's what we want to do. And the associations, I think, Charlie, you spoke to this week as well about it, because, of course, whenever we talk about mortgage fraud and there is the word broker in it, we have to kind of be like, what are the issues here? Because we want to be really up and proactive about what is being done. And what do they have to say?
we reached out to the MFAA and the FBAA, and obviously this was after the developments and the update that we received from Austrac, and the two associations stressing a unified approach from the industry at large to really tackle this and stamp this out at all levels and all practices. And Anya Panak, a CEO of the MFAA, noted that the association was actively working with lenders and aggregators to develop a baseline referral framework, which we know they're doing, to strengthen that oversight and the safeguards over the referral arrangements, which is kind of believed to play a role in this fraud scheme, and also strengthening and the verification system and making ATO data available through the consumer data right. We know that that's something that MFAA and other associations have been working on
Lots
to
of
really
lending associations,
push the government and Treasury to open that up. An ongoing campaign, and the Experion head of fraud was also really pushing for that to take place. But yeah, just stressing the protecting the integrity of the lending system, and also kind of outlining that it is believed to be a small cohort of brokers. This shouldn't tarnish the industry with a general brush.
Yeah.
And that it's a believed to be a small cohort of kind of brokers and third-party entities involved in this. And the FBAA was stressing that in their CEO, Leo Gatchett, was really stressing that as well. And they've done a lot of work on the referral system. It should be noted that a couple of months ago they called for that to be stopped. The bank's referral
introduces, you mean?
Introducer schemes.
I was like, we need referrals. What are you talking about?
No.
Yeah.
I've conflated the two. Introducer schemes that the banks do run. So he reiterated their calls to shut that down. The banks that are still running those introducer
and
schemes.
we wrote about the story both on the Advice on Analysis publication Broker Daily, and kind of have been for months talking about, how can brokers protect themselves? The associations are doing a huge amount of work on that. Also talking to technology people about what sort of tech that can be developed to try and identify any kind of AI created documentation, and again, looking at what sort of responsibilities brokers have when it comes to really verifying this type of information, because of course it's very legitimate looking, can be hard to verify. So the ATO data would be pretty helpful, so you're not having to rely on pay slips or income. You can be like, it's
Plug
from
in.
the source.
Directly.
So hopefully it's sort of less easy to manipulate.
There's some interesting comments in that story as well from Sean Koyani. He's the CEO of Fatiris, which is a fraud technology provider, and he was just sort of saying manual checks alone aren't going to cut it anymore.
No.
They're saying like 7% of the documents he sees exhibit signs of fraud.
7%?
Yeah, lenders sort of need to sort of start. And I would have thought lenders were already sort of using technology quite robustly when sort of assessing these applications. But obviously there sort of needs to be another level, a layer of filter. I'm not too sure.
Fighting AI with AI.
Yeah.
Bots take on the bots. And I think this is something, as we say, like we've seen all the banks pretty much investing pretty heavily into their technological teams, particularly when it comes to cybersecurity and protecting their systems from AI generated fraud or from any other type of nefarious technological
advancement.
Yeah. Thank you. I was running out of words there. And I think, so as we also talked to banking associations and lending associations, they've all been saying we're working on it, we're aware of it, we're all agreed and working on the same path. And it's great to see, I guess, this, really full cross-industry work being done to try and stamp out fraud. And as we know, we've already seen a lot of action being taken in not just the broker market, but across the board when it comes to bankers and accountants and lawyers and participating in these schemes.
The associations are more or less involved in this as well. Austrac's writing to all entities, including industry associations, on what to tell their members too.
Yeah.
So it's really all hands on deck with this kind of thing.
Yeah. The last year or so, we had a huge amount of loans being written. Last few months since the budget, that has cooled down a bit. It's still obviously pretty high, but down from where we were. So it feels like a loss that, everything's cooled down from housing loan commitments. And I think we've been seeing, again, some data the last few days and really the weeks coming out, especially as financial reporting season comes on, looking at, what are the demand for flows looking like at the lenders and from the aggregators. And Charlie, you've been reporting about this week. What's sort of the main takeaways for you?
Yeah, so we've written a couple of stories on mortgage demand statistics and what the flows look like, both from like credit reporting agencies, government sources such as the ABS. We've got the lending indicators, which I'll just delve into soon, and also the major banks are still reporting. We've got NAB, their third quarter results earlier in the week on Monday, and we also got AFG at the back end of this week too. So a lot of information coming in. But yeah, on these lending indicators that we received late last week, it's the June quarter. So there's obviously, I did emphasize this in the story. There's a
Old
delay.
data.
Oldish, but it has definitely clocked the widespread fall and pullback in mortgage demand. The agency reported
This is the ABS.
This is the ABS, had in their data release reported that new loan commitments for dwellings in the June quarter, so for owner-occupiers, it fell 3.3%. For first-home buyers, it declined 2.9%. For investors, it fell 8.6%. And despite being partially higher than it was a year earlier, the annual growth rate slowed by about 20%. From the March quarter.
Yeah.
So it's a proper step down.
And because it's the June quarter, so it probably includes half of it is pre-budget, but that's already when the rates were relatively high, and the other half is post-budget. So when things started to really come off a cliff.
Yeah, exactly. And you've also got it's widespread. It's all around the country. It's in every state. It's not confined to
Sydney, Melbourne.
Exactly. Yeah. Like it's all around the country. It's every borrower category and age group as well. So we're seeing that in personal loans and auto finance. That's come down as well with numbers we got from Equifax earlier this week. So it's not just mortgages. And not just mortgages too.
I think we saw this again, like we talked about it, I think last week when with the sort of the banks reporting their results, and CBA had flagged that they'd seen something like a 15% drop in mortgage applications pretty much since the budget, or at least in the last sort of 3 months. And they were talking about, obviously things like rate rises playing into that, the budget changes playing into that, but also, things like serviceability playing into that.
Yep.
But I would flag, and this is from the CFO at CBA, Alan Doherty, and he was saying, don't kind of forget that we're coming from very, very high numbers. He's like, pretty much since 2020, house prices in Australia went up 70%. Like, this is a huge amount of growth we had.
Yeah.
Things are kind of coming back. So he's saying, even though we're having a drop in things like house prices and applications, he still thinks that housing credit will grow over the next 12 months, 4 or 5%.
Yeah.
So it's like, it's not actually, a travesty that you're kind of seeing, even though the headlines kind of reflect that. Like, yes, house prices are coming down, so we might be down around 10%, but generally 10% off of a 70% rise in 6 years, like maybe that needs to come back down to those sort of early January 2025 type levels to make things a bit more affordable.
Yeah.
Probably won't be too long before it goes up.
I fully expect that we will be back in the growth period, a rapid growth period again, as soon as things change. But you never know.
The banks are saying conflicting things as well. Like, we got NABs, along with their results, we got their credit growth forecasts, and they'd undercut total credit growth by about half from where it originally was. And they've got investor credit growth, that's for FY27, to drop by 1.4%. So
that's
nothing. But also, if you kind of tune into to commentators noting that, well, if those numbers prove to be correct, then the downturn is going to be larger than the banks and kind of economists are predicting. So it's worth watching. But also, like you said, we're coming from exceptional highs.
Yeah.
So let's be real here.
Yeah.
It's not. It's nothing major.
Yeah. And I mean, we've seen this again with all the commentary from the RBA last week with the cash rate and people saying, well, surely now we can't have any more hikes because things are so high and we're not yet there. So, who knows what it'll be in a few more months' time. But I think, just interesting to see that sort of more information coming through as we look through the end of FY26 reporting. A lot more coming through both this week and next week from the lenders. I think we've got a lot of non-banks next week as well, looking at their financial year results. So we'll be covering those probably next Friday as we unpack those. We'll take a quick break here. When we come back, it would be good to look into what else has been happening in the mortgage market, and we'll get into it just after this. So looking at some more housing data and mortgage data. We just absolutely love getting our fingers on original data and data sources and pulling it apart and having a look at what it's all telling us and trying to translate it for our readers into why this should be important to you. And one of the things we've been chatting about a lot the last few weeks has also been negative equity, and loads of people making a huge fuss about first home buyers, particularly those in the 5% deposit scheme, going into negative equity as house prices drop. And we keep on saying, does this really matter? Like, if you've just taken out a home loan and you're paying your mortgage and you're on time, does it really matter if you're in negative equity? You're in the market. Yes, it's annoying to be paying a mortgage that is potentially higher than your house's worth, but you'd hope over the 30 years that you have that house, it would come back round again and you would no longer be in negative equity.
Long-term investment.
Lots of commentary around that in mainstream media, which we've been finding kind of annoying. And then this week we had some data which actually showed that it's not really a big thing.
Yeah. So REA Group released some data this week, sort of giving us the full extent of how many first-home buyer households are in negative equity at the moment. I must admit, when I first read this story, I misread it.
Me too.
I first read the lead.
I had to squint my eyes a couple of times.
I'd read that 87% of first-home buyers
87%
are in negative equity, and I was like, crikey. But no, it's just 87 first-home buyer households purchased under the expanded 5% deposit scheme are currently in negative equity, which is less than 0.2% of the 48,000 properties that have bought through the scheme since October 2025. So that just shows it is a small segment.
And as we say, 87 households have negative equity who went through this scheme, but how many of those, I wonder, are actually thinking of selling and will be impacted by that?
Yeah, exactly. And I guess for a lot of these people who are buying their first properties, it's a place to live. For all of them, it's a place to live, and it's somewhere they intend to live for a long time.
Yeah.
So
I don't want to sound callous by being like, it doesn't matter, but I'm kind of also like, it doesn't matter.
Yeah. And I mean, from what we're seeing, like, property prices should go up at some
hopefully
point.
But data like this helps swim against the kind of mainstream tide that's being peddled at the moment, because, they're always going to be criticizing the government. That's their entire prerogative, to be in opposition. You've got the coalition and kind of One Nation as well, espousing this argument. Those who, obviously, those who entered the expanded 5% deposit scheme are most at risk. Because they've got fresh loans and they're
low savings.
Low savings, and their loan sizes are probably the likeliest to eclipse their actual home values. But come on, they've got it's probably typically going to be a 30-year term. They're likely not going to pay it off before the term ends. Maybe they will, but it's. I
mean, and they'll probably refinance 1 million times between then as well.
Shut the deals out there as well.
Yeah. So I guess that does make it slightly harder to refinance if you're a negative equity, obviously. But again, you would think people who've entered the scheme since October 2025 will probably not be thinking of doing that for a while.
It's interesting. Yeah, it was interesting. The data also sort of gave us sort of around the grounds approach of the strongest equity positions around the country. Queensland Outback, those borrowers were at 14.2% equity. West Australian Outback was at 12.7% equity, which was the strongest performers. And probably unsurprisingly, Sydney Eastern Suburbs had the lowest estimated equity position at 0.8%, followed by Melbourne Inner East, which was just 1.9%.
Because we've had the biggest house price falls.
Yeah. So, interesting data. And I think it sort of brings it all into perspective, particularly sort of when you see how this sort of negative equity issue has been handled in the mainstream press.
I think REA, obviously this data was from REA, but I think what REA was also saying was, people's equity buffers and protections are starting to tire. This is speaking about that group that's on those expanded 5% deposit loans. So they think that, if this downturn extends for longer, then that negative equity cohort among those 48,000 loans that were written in that time frame could extend, could grow larger.
Yeah, and I guess it'll take them longer to move through lower LVR brackets and all those sort of things and access better rates. But again, we have to take it with a pinch of salt and kind of go, they are in a property. If they're not under a repayment strain, then they still have a property, a house that they're living in, probably quite happily. So
and it's not a unique thing, like as well. Like you've got other countries around the world where, you know, they experienced massive price growth and then had a downturn and haven't really recovered from it since. So
although I think Australia is one of the anomalies in that it went up 70% in 6 years.
I know, right? It's I just need to keep reminding people of the kind of context here. Yep.
I think like outside of all the data that we've been looking at, we've also been looking at what's been happening in the industry more broadly. There's been some more M&A activity in the broking space. We've had a couple of brokerages buying each other or merging with each other or subsuming each other. One of the big ones this week, Charlie, was the top 25 brokerage SmartMove, no longer going to be a brand.
Yeah, so yes, obviously we got this update earlier on in the week. Viridian Financial Group had said it had mothballed the SmartMove brand, and this is a top 25 brokerage. It was the strategic integration with the financial services firm was announced in mid 2023. However, it's now been rebranded. And the group said it was kind of consolidating its mortgage broking operations under a single banner with its financial advice section, and fusing them together because they said they're becoming, you know, closer aligned, and there's they want greater collaboration between the two, and they've retitled SmartMove to Viridian Lending. Cameron Wiles has been appointed General Manager of Lending.
Yeah. So we got Viridian Lending now.
Yep. And
we know, as you mentioned there, Charlie, top 25 brokerage. You might recall at Better Business Summit this year, we heard from Viridian actually talking about how they've built SmartMove and /Viridian Lending into a top 25 brokerage, because it has a lot of brokers. It has its own sort of training academy. It has its own back office support, both I think in Nepal and in Manila. It's a huge brokerage. And so, having it now under the Viridian Lending brand makes it kind of more clear that it's part of Viridian Group, I think, rather than having two separate brands. So I think for all intents and purposes, not much change other than the name, really. But still, it's sad to see a big major brand like that go, because we know SmartMove over the years done really, really well. And as we sort of mentioned there, it's not only been a top 25 brokerage, but I think last year it was actually the major independent brokerage of the year at the Australian Broking Awards, which are coming up soon. And it's won lots of awards over its career. So farewell to SmartMove and welcome Viridian Lending. We did also hear from some smaller brokerages as well. So Acceptance Finance recently merged with Apt Wealth or APT Wealth Partners, and that's quite exciting. So they've got a strategic partnership bringing them together, and really, I think they're going to manage something like $5 billion in funds between them and loan assets as part of this merger. And it's really about kind of, again, taking advantage of scales of economy of scales, even. There we go. And kind of looking at, well, who do we have in the group? How can we broaden out our offering to our clients, and kind of built, these two really strong brokerages and kind of financial service businesses with professional partners that can provide many more services to our clients. So kind of being like, this is a great opportunity for our clients. It's also obviously a great opportunity for our people, for our brokers, and kind of making sure that we continue to do what we were doing. So there's not going to be any kind of immediate change, I think, to branding as they kind of move forward as yet, but then really working as a combined group to take advantage of things like their referral partners, their technology sort of systems and things like that. So kind of integrate progressively over time, I imagine, as they will merge fully into one being. But seeing, I think, both of the co-founders, so Acceptance Finance co-founder Daniel DeConza continuing with the group, and then kind of, helping to really build the brokerage onwards and upwards. So we'll see more from them, I'm sure. And if you didn't catch that story, you can find it on our sister title, Broker Daily. We're going to take a quick break here. When we come back, another big government announcement, this time in the form of changes to the compensation scheme of last resort. We'll get into that after this message break. So CSLR, compensation scheme of last resort.
It's a mouthful.
That is hard to say.
Yeah, it's a mouthful.
No wonder we call it CSLR. Has had some tweaks. And again, we've been talking about this for years because it has had such a pain in the bum for so many people given how much money is being compensated.
Yeah.
And after many, many rounds of consultation, we've had some updates from the government on what they're going to be doing with it moving forward. Daniel Molino talking this week, wasn't he, Charlie?
Yep, he spoke this week at the National Press Club, and he was announcing a whole bunch of reforms, mainly targeted at superannuation. But in and amongst those reforms that he was announcing, he also unveiled a package of changes to the CSLR, and this was kind of including a new approach to those exceptional levies and imposing narrower compensation settings and this kind of thing. He said this was to secure the long-term operation and viability of the scheme, which obviously pays eligible compensation where an AFCA determination cannot be met by a failed company. And so this is after kind of numerous rounds of consultation, a lot of consultation.
Many rounds.
And a lot of recommendations from associations like the MFAA who were really kind of active on this. And we'll get into their comments on these changes soon. So I'm just going to run us through the changes. One of the central changes would limit CSLR payments to a consumer's actual financial loss for applications made to AFCA, and this is after 30 June 2027. And the government said this would basically measure whether or would not alter AFCA's existing compensation powers or consumer entitlements through the external dispute resolution body. Instead, it would limit the amount payable to the CSLR once a company was unable to satisfy an AFCA determination. So one of the central changes would limit CSLR payments to a consumer's actual financial loss for applications made to AFCA after June 30, 2027. So this would remove the scheme's exposure to compensation calculator that includes hypothetical
unrealized gains.
Unrealized gains or returns an investor may have kind of achieved had misconduct occurred.
And this is crazy. I mean, the fact that it was even a thing to begin with, that people could complain and say to AFCA, I would like to be compensated for what I should have earned on these investments, but because of something going under, I didn't get the money I thought I was going to.
Yep.
It just seemed crazy to me that companies were then having to pay compensation for unrealized gains, because that's not what the scheme was set up for.
No.
And so especially in the financial advice section, obviously, of the finance scheme, that is a huge amount of money because of all of the major collapses, as we know, from First Guardian and Shield and all those sort of companies that have been causing these blowouts in the CSLR. The unrealized gains factor has been a major headache for people in financial advice, saying, why are we as an industry having to pay for unrealized gains for this company's problems when surely it's not actually about something that's kind of, actual loss. They haven't actually lost anything.
No, it's kind of speculative at that stage.
Yeah.
They haven't actually lost the money that they invested.
So that makes sense to me to close that and make it much more just about actual losses.
Yeah.
What else has changed?
So they've also altered the funding of exceptional losses. So the government said it would introduce a more, what it said, predictable framework for funding extraordinary CSLR costs. And we know this is through the special waterfall levy, but they've actually changed how that waterfall levy now operates to when we received those draft changes from them a couple of months ago.
Yeah.
So he said the model was now intended to better connect funding to actual sectors that were responsible for or associated with the consumer harm. So under these new changes, the subsector most closely connected to the claims and losses would be considered first, which it wasn't like that initially.
I know, it was a head scratcher before.
Followed by other connected sectors. Before then, under like real extreme circumstances, if it can't be paid, then a wider funding base could be called upon. But that's only if costs remain, and they don't think it will under this new model.
Because, I think in the original waterfall, if anyone was just listening to this podcast for a long time, when they first put it out, I had to read it for about 2 hours. I was like, I do not understand what they are saying here. I was like, so what they're saying is that the industry who is most closely related to it doesn't pay the most? That doesn't make any sense to me. So I'm glad they've changed that too.
Yeah, when you sort of frame it like that, it starts to make a lot more sense.
Yeah.
And sort of you can sort of see how that model would be superior to what's come in the previous previous
very
year's
confusing
assessments.
waterfall approaches.
What's even better, the MFAA especially thinks, is that the government is also going to use the new waterfall framework for the FY 26-27 special levy, which we know is coming.
And we can't wait for it.
And so they're going to adopt the same method when they actually calculate that special levy, and whereby the sectors that are most closely associated with the wrongdoing would bear the brunt of that special levy. And the MFAA, who responding to these changes when they were announced, really welcomed that. And they said, it was an important step forward, and kind of stressing that mortgage and finance brokers have a really low claims profile under CSLR. And so businesses that are doing the right thing shouldn't then be kind of bear the brunt disproportionately and fund those significant losses occurring somewhere else in the financial system. And the MFAA has been advocating for this for a while.
I think, a lot of associations have been. But was it Naveen Alawala you were talking to about that?
No, these comments were from CEO Anya Panak, but Naveen was in the room. Obviously,
she was there.
She was there. She was on the. She was on the front.
She's been doing a lot of work on this, which is why I thought maybe it was her. But there we go. The whole MFAA, and lots of the associations have been working on the complaint schemes and the funding schemes and all the levies you have to pay for the joy of being a broker.
The government is also going to consult on the special levy itself broadly with stakeholders and associations before it's announced, which the MFAA welcomed.
The actual number, you mean? Once they've set the actual figure. That'll be interesting.
Yeah, so I think there's going to be some input there on the makeup and calculation of this special levy.
Yeah. Well, we've covered a bit of ground there. Ben, for you, what are the big highlights of this week's news? What are the big takeaways that you're kind of coming away from?
Austrac was a big one for all of us. But I was really interested to sort of see the investor figures, just in light of sort of all the reforms that sort of came and sort of seeing if that had tweaked things. And I was also writing something for a September mag.
For the September mag, I was going to say the investor feature, you've been
investor lending as well.
busy.
So that came right on time.
Yeah.
But there's always so much going on, I guess.
If you didn't know that we have a magazine, we do have a monthly magazine and a quarterly supplement that comes out with it, which is available to premium members. If you're a premium subscriber, you get it sent to you each month. It also goes up online as well. And Ben is our wonderful commercial content writer here, but also very good feature writer. So you can have a look at our longer form analysis and more in-depth sort of structural overviews of what's been happening in the market. The September edition, obviously, all coming out in a few weeks, but the August edition is out now. And that's all about what do brokers think of the mutual banks? What are we seeing in things like green lending? What are we seeing in bridging finance? Lots of like kind of thematic overviews, what's been happening in industry and what brokers can be doing to help grow their businesses. And the September edition will be really focusing on what the non-major banks have been doing. But before that, we've got the Australian Broking Awards next Friday, the 28th of August. Very excited. Are you gents excited? Are you going to get your glad rags out, get your tuxedos? Actually, I think it's cocktail. I don't think it's black tie.
Yeah, I was going to say it's going to be odd wearing a tuxedo during the day.
Yes, at 11 o'clock in the morning. Yes, in your fancy frocks and your suits.
Yeah.
I am hyped for it though. I'm excited to meet all the finalists and brokers that have done all this hard work.
Yeah.
To go to that next stage and like share and revel in that excitement with them. It's always good to see that human triumph type of thing. And when someone's really excited, it's always really good to see.
Yeah.
Yeah, it is one of our really big events. I think arguably our biggest one, I guess.
One of the biggest. Yeah.
Better Business. So, it's always a big highlight of the year for us.
Yeah, our big national awards, the Australian Broking Awards. And it's really wonderful to see so many people from across the aggregation space and lenders and fintechs and brokers all celebrating. I absolutely love hearing the speeches from the winners as well. I think it's so wonderful to hear what they've been doing, what it means to them, them thanking their teams, thanking their partners. A lot of them bring their partners with them to their life partners. I mean, not necessarily their work partners with them to the awards. So you get to see sort of very proud other halves that have been supporting them emotionally through their journey, getting to celebrate with them. It's so wonderful. So I love our awards and a daytime awards as well. I also really love because you can have this amazing celebration and then start your weekend early.
Nice, how good.
If you haven't yet bought your ticket though, I think we are almost sold out. So move quickly.
Do
if
it.
you haven't already got your ticket, you can go to australianbrokerawards.com.au and you can listen to the podcast that Charlie and I recorded earlier this week for the finalist showcase podcast on The Advisor, which goes through some of the broker finalists. If you want to know what they've been doing, what makes them special, why the judges thought they kind of would deserve to be a finalist, and obviously then get to know their names before the day next Friday.
Crept up on us really quickly.
Very exciting. Ben, Charlie, thank you so much for your time today, and thank you all for tuning in. If you've got any questions for us, and do feel free to reach out. You can reach me at editor@theadvisor.com.au, and of course, take a listen back to previous episodes on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.